Welcome back. Let's talk about individual stocks sector. Siddhartha Khemka, the head of retail research at Motilal Oswal Financial Services, now joins in. Siddhartha, morning, and thanks so much for joining in. One of the stocks providing leadership today is Reliance Industries. It's up 1.5%. There was this big call made by Morgan Stanley. They say it's their top pick in the sector. They've put a target price more than 3,000 on Reliance Industries. But the stock is coming off a period of underperformance. Can you tell us your thoughts on Reliance? What is it that was troubling the street post the AGM? Because the stock corrected last week.
Yeah, very good morning, Rima. So if you look at, there was a big expectation out of the AGM from Reliance. So there are multiple factors that are going in and leading to this underperformance in the stock. One, the biggest expectation out of the AGM was any visibility or clarity in terms of the value unlocking. Investors have had enough patience of almost last 10 years of getting invested into the newer age businesses of that of Jio in the telecom and digital play and the retail business. And there was no such information forthcoming in the AGM, which kind of disappointed the street. But that was more in terms of expectation. But if you look at the core fundamentals, I think the big capex announced in the AGM, that is kind of a dampener. Although this capex will help the company in the longer term, their plans in the newer energy segment, their plans to launch 5G in the telecom business, having seen market leadership and the kind of maturity in the 4G growth now, I think transition to 5G is very essential. But at the same time, the huge capex, the 2 lakh crore capex for 5G rollout over the next few years, the 75,000 crore capex in the oil to gas plus new energy, I think that could dent the ROEs in the near term. We have seen ROEs in the range of high single digit, about 9.5%, which could get under pressure in the near term once this capex, because all these are capital intensive, high gestation businesses. So the returns will be back-ended, will not see the growth or returns from these investments, but it will have an impact in the near term.
All right, Siddharth, good morning and thanks for joining us. You know, one space that we have been talking a lot about, of course, is the entire auto pack. It's seen a big run-up. We also had the sales figures coming through last week. How do you approach this? Do you think that there's a lot more room left for these stocks to rally? And if yes, how would you approach this? Is it through the EV theme? Would you look at the two-wheeler pack or, pick some of the larger four-wheelers?
Yeah, Pavita, good morning. Auto is something that, again, after almost 1.5 to 2 years of underperformance, started seeing improvement on multiple factors. The improvement in the semiconductor supply chain. B, improvement in demand post the healthy monsoon, plus the upcoming festive season. So I think a lot of these stocks have run up. So our view on the overall auto sector continues to remain positive. However, if you are looking at a fresh entry, I think the risk reward is not that favorable at current levels. Any dips because of whatever is happening in the overall market can be a good entry opportunity. If you look at what are the preferred plays, I think one has to be positively looking towards the passenger vehicle segment, which looks very interesting given the upbeat festive season, the strong pent-up demand, as well as the improvement in the semiconductor. So in that space, obviously the preferred pick is Maruti. If you look at some of the other players, like M&M has been also doing very well with their new launches. And Tata Motors clearly in the domestic business has seen sharp improvement in the domestic, mainly because of their strong performance in the EV space, which by far they are the leaders. Within the two-wheelers, I think there are selective plays, but I think a lot of the stocks have run up. One can look at Hero Moto or an Eicher at this point in time.
Siddharth, what about the hotel stocks? Now, Indian Hotels has made a fresh 52-week high. EIH was at a fresh 52-week high just last week. Lemon Tree is very close to those levels as well. Now, urban consumption has done exceedingly well. Despite the inflationary pressure, travel is back, occupancies are high, hotels have managed to increase the average room rent as well. But after the kind of run-up that we've seen in the stock price, Indian Hotels has doubled in the last 1 year. Is the risk reward still favorable?
So, Rima, if you look at what is happening is that some of these niche consumption sectors are doing well, be it the QSRs, be it the retail, be it the hotel space, and rightly so, because after a long period, I think the sector has seen sharp improvement in demand, in occupancy, as well as in the ARRs, and that is the benefit that these companies have. These stocks have seen as a reflection. As you rightly highlighted, the risk reward, at least in terms of Indian hotels, at this point in time, we are positive, but doesn't look that good. If you look at Lemon Tree, that has corrected from its highs and is relatively better placed in terms of risk reward. So the company is also preferably positioned within the business destinations, with 86% of its inventory focused towards business travel, where we have seen a sharp improvement. Plus, if you see, the focus is growing with the asset-light model, the management contract model, which is kind of keeping the balance sheet pretty strong. So we are expecting a strong revenue growth of almost 50-55%, with margins improving. EBITDA is expected to grow almost 85-90% over the next 2 years, leading to an improvement in ROE. So I think at this point in time, would prefer a mid-cap player like Lemon Tree within the hospitality space.
All right, Siddharth, we'll leave it at that today. Thank you very much for joining us and taking us through your call on all of these individual sectors as well as stocks. It's a wrap on the show. The market is